Welcome, traders, to a very special Halloween edition of the Traders Brew Podcast, Trade or Trick. Today, we are going to talk about the many, countless horror stories in trading. These are the tales your analyst warned you about. Just like the jump scare that gets you screaming, markets are scary. Markets that are scary bank primarily on the element of surprise. So going into the markets without preparation is like going in with the intention to get tricked. As your host today, it is my job to put on a brave face. See, I ain't afraid of no ghost, and I guess I'm not really alone in these dark woods. The lantern today guiding us through the ghoulish miasma is Ash Afshar, market analyst from VT Markets EMEA. Ash is no stranger to the markets, having seen election shocks to unpredictable market crashes. He has over 15 years of experience and first started his journey as a private trader. He has worked with many brokerages across the UK and privately with individuals from Dubai as well. With him as our guide, I'm quite certain we will uncover the real terrors lurking in this volatile season and make it through to the other side. Hello, Ash. How are things?
Ooh, hello, Devin and fellow traders. Thanks for the invite. I'm very excited to be here today, especially for this Halloween special.
Yeah, I'm really happy to have you here as well. I honestly, when they first pitched the idea for me to do a Halloween special, I was like, "Whoa, how can we tie the two concepts together, right? Like financial markets and Halloween." Yeah, but I suppose there are really some really scary elements in the markets out there. You know, what do you think of that? Is do you genuinely think, given your experience, that the markets are scary?
Most definitely, there's always ups and downs. There's always little tricks and treats that you can take advantage of. Things that can stumble you, things that can scare you, make you look like as white as a ghost. So definitely there are things there.
Yeah, I suppose that's true, right? That's why I use the term lantern to describe you, because I mean, for many, right, the markets are quite a murky sort of like, you really have to discover your way forward. And for many folks out there, there's no real sort of guidance, right? Even though there are classes, everybody has different like risk appetites, different, they have different way of trying to get to that destination. And I think, I think, you as a lantern, having, your vast amount of experience will be very helpful for the listeners of our podcast.
Definitely.
Yeah, on our side, we have a really, for this special podcast, we have prepared a couple of fun activities. I think one of them is, we have some terrifying trading tales from our Reddit community. And we're both of us, right? Clearly, I'm not as experienced as you are, but we're going to decide whether each tale was a trade, which is a smart move, or a trick, which we will consider a horrifying market mishap. So for our listeners, will these stories spook them into never trading again, or will they just laugh them off as another market hiccup? I think both of us will have to evaluate what will bring the biggest trading fright to the table in this episode of Trade or Trick.
Absolutely. Well, let's hope it doesn't scare them too much. We just want to give them a little spook.
Okay, but let's talk about the most, I guess for me, right? Because I never really understood the markets, right? So for me, it's really scary when election season comes around, and that's coming really soon, right? I think somewhere in the next few months.
Yes, starting beginning of November, actually, I think. Yeah.
You are nervous? Can you imagine the rest of us?
Always. The elections are always fun.
Yeah. So with the elections coming closer, right? Based on your experience, and you have 15 years of them, how do markets usually react? And is there any sort of preparation we can do to sort of like nullify the uncertainty that follows it?
Yeah, look, obviously election season always and usually brings increased market volatility. That's all due to the uncertainty of potential policy changes and their impact on all the different sectors. Because as you know, we have two different parties going up against one another. One has one type of policy, the other one has another. So when you're looking at it and trying to put it into perspective, it can be quite daunting when you don't know really what's going on and what it could lead to. Now, historically, markets are a bit shaky leading up to the election as traders brace for potential shifts in either taxes, regulations, and spending based on which party wins. Normally, in situations like this, we sort of can categorize it into two little small sectors. It's either pre-election volatility, for example, with the tech sector, the healthcare stocks, they tend to react strongly to policy announcement because, the Democrats might say one thing and the Republicans might say one thing. And then, of course, you have the post-election reaction, i.e. the results. So these are the sort of things that we need to sort of brace ourselves and look into before taking it. But it can be a bit shaky, of course.
I see. Right. So right now, I think we have, our two very obvious candidates. We've got Kamala Harris and Donald Trump on stage, right? And they're both
Of course.
going at it, right? Yeah, the whole presidential debate. I think all of us have watched it. They're very different people, right? They give very different vibes. What I want to know is, while they are trading jabs, right? How do you see the markets reacting? And I mean, you're obviously tracking the markets at every given turn, right? So how have they reacted so far? Do you see investors panicking and pulling out, or are they just thinking, we've seen worse, let's buy more?
Well, look, it's always daunting, especially when you have someone like Donald Trump, going up against any other presidential nominees that there is, because obviously he's such an unpredictable character. He can shift markets like there is no other. But obviously, when it does come to that, during debates like between Kamala Harris and Donald Trump, of course, the markets are likely to experience usually short-term volatility. It all depends on what they're saying, and what the topics are. The reactions usually depend on the specific policy comments, because you could have one debate that could be discussing, one matter, with another debate concerning taxations, interest, and whatnot. So it just depends on what they're actually talking about and the comments that these two individuals make that can show that little volatility. But investors typically don't panic. That's the main thing. But they watch it very closely for sector-specific impacts. Like, again, when they're discussing healthcare, when they're discussing the energy market, whether they're discussing the tech sector, and they just usually adjust their positions accordingly when it comes to that. So not so much too panicky, but monitoring it very closely.
I see. So it almost feels, at least for me, like a fastest fingers first sort of thing. Everybody wants to be, they have to respond quickly, right? And they have to anticipate very quickly. So given that we are just everyday folk, right? Obviously, people that have skin in the game is not just people that are institutional investors, that sort of thing. Do you think everyday investors and traders should consider adjusting their portfolios based on who's leading in the polls?
Look, when it comes to that, it's always a sort of, how should I put it? Best way to put it is just a word of advice. Adjusting portfolios solely based on who's leading in the polls can be quite risky and may not always lead to the best long-term outcomes. The reason why it can be because of polls can be quite unreliable. Polls provide a snapshot of public sentiment. Long-term focus. But for long-term investors, for example, generally better to focus on the fundamentals, such as company performances, the economic trends, and diversifications, rather than the short-term political developments, because whatever might happen right there and then could, cause more distress onto your trading than actually good. And in short, it's just staying informed and staying smart, but making dramatic portfolio changes based on only poll results can lead to more harm than actual good.
I see. Yeah, and I think it's like this poll thing. I mean, I'm old enough to have saw the first Trump election, right? And we saw that Hillary was leading in the polls, right?
Oh yeah.
So and but in reality, it was quite a different story. So I think if the polls, like you said, could be wrong, and when it's a bit of a reality check, right? When the final results are in. So too many variables, might be wiser to stick with a given strategy than to just base it on what's leading in the polls. Yeah.
Right.
I'm curious about 4 years back, right? I'm relatively new to the markets, right? So I wasn't tracking when these things are happening, right? So how did the financial markets react when there was no sort of like clear winner, or if there was like some sort of delayed election result, like back then in 2020?
Oh yeah. So with back then, 2020, that was a story in its own. Was obviously with the counting of the mail ballots, Trump obviously making the announcements that it's all rigged and it's taken too long. All the various states taking their precious time to give us the vote. But that in itself, for example, made up of almost 46% of the vote in 2020. But markets typically experience relief. Now, especially if the outcome is clear, but like you mentioned, dispute in elections like in 2020 can cause prolonged uncertainty, and investors usually focus only on key areas like tax policy, regulation, and international trade, because these are sort of let's say, the bigger sectors that can affect the economy and the volatility of the market in itself that can shift, let's say, the health sector, that can shift the Forex sector in a direction of the policy in itself. Because obviously it's just showing to us, what the individual or independent party in itself, whether it is the Democrats or the Republicans, are actually trying to do. And it just showed their colors. In 2020, we saw how Trump behaved, his reactions alone against, when they stormed the Capitol, based on his comments and announcements, made a shift. But again, I'm not sure, obviously, if you can remember properly, but the shift in itself was temporarily. Again, it was fairly short. And it comes back to what we just discussed just a little bit earlier. Markets do react, but usually when it is around the election time, especially when we have these sort of uncertainties or not the clearest path yet until it's the full announcement, we have the bit of small volatility in the market, but that can sort of correct itself over time once we have that clear winner that then shows us, okay, we're now going down the path of the policy of the Democrats or down the policy of the Republicans.
Makes sense. Right. So,
Yeah.
and I understand, like, typically, in times of, I guess, volatility, there are a couple of assets that you can move towards to sort of protect your capital, right?
Definitely.
I mean, can you, are there specific asset classes that, typically perform better during the election uncertainty, and what are they?
Of course. So in short, the answer is always yes. There are certain asset classes like gold, bonds, and safe haven currencies, as we like to call them. Reason being, let's take gold, for example. Safe haven appeal in itself. Gold itself, for example, is traditionally viewed as a safe haven asset. Now, during times of political or economic uncertainty, such as elections, investors often flock to gold to preserve value. That is just something that history has shown us. Of course, the one thing that we always say, history does not necessarily, prove what the president is going to do for us, but it can give us an idea, that gold is one of those assets that, people do tend to flock towards to. Taking bonds into account, for example, US Treasury bonds or yield drops, for example, government bonds, especially US Treasuries, are another safe haven asset. When markets uncertainty increases, investors normally move capital into bonds, which are perceived as low risk investments. And then, of course, we can go towards the direction of, let's say, our everyday day-to-day trader. We can look towards safe haven currencies, currency pairs that everybody sort of knows about. Dollar versus the Swiss franc, for example, or the dollar versus the Japanese yen. Why? Because investors normally turn to strong, stable currencies like the ones I just mentioned. Why? Because these currencies are usually considered safe havens due to the stability of the respective economies. So these are the sort of the assets that you have your traders flock towards during these sort of uncertain times, especially when we have these elections.
I see. Now I've heard, so how do I put this? This is a little bit contentious because not everybody agrees, right? Not everybody agrees. It's a fairly new asset class.
Right.
It's a fairly new asset class, and some people think it classifies as a safe haven itself as well, or some kind of digital gold, right? So I'm talking about Bitcoin. Right? I've heard that there's not been quite a big rally in Bitcoin around election times, or even during times of more significant volatility, right? So do you think people are just buying Bitcoin because they are worried politicians will mess things up, or is it some kind of secret election strategy that's happening behind the scenes? Like,
well, look, Bitcoin has always been a hot topic. Let's put it that way. The one thing I can say to a certain degree is that it's not necessarily a secret election strategy. People aren't buying Bitcoin because of a secret election strategy. Let's put it that way. But rather than as a hedge against uncertainty and traditional financial systems. Because as we know, in the financial systems, whatever you're trading, whatever markets that you're trading against, there's always one factor or another that can impact it and move it in a certain direction that could be quite beneficial either to the economy, to the region that you're trading against, or the currency that you're trading against. But Bitcoin's appeal as a decentralized, inflation-resistant asset makes it attractive during times of political and economical instability. When we have elections, when we're uncertain which party is going to come into power and which party isn't. Factors that election naturally amplify. However, speculative traders also play a role in driving up the demand as they capitalize on these dynamics when you're looking at this. So it's just a combination of these little things, not so much a secret election strategy, but more, the fact that it's a decentralized asset, inflation resistant in that aspect. And, traders usually sort of flock towards that. And that's what they take. And normally during these sort of periods, this is what you're seeing. And this is why we're seeing Bitcoin all of a sudden go from lukewarm or warm to spicy hot. Let's put it that way.
Okay. But we've talked about safe haven assets, right? So it's
Yes.
usually more of like I guess a protection sort of style of trading, protective style of trading. You're trying to keep your capital, right? You don't want to get too affected by the volatility that ensues from, say, a major election. So, but for those who aren't super interested in taking that protective approach, right? Do you see opportunities for traders to capitalize on the short-term volatility that elections often create?
Yes, definitely. Look, it's always an opportunity for traders to capitalize on such events. These events is one of those things that we like to call event trading. So you have variations of trading types and trading methods that you're doing. And one of the ones that, traders do look, obviously, besides swing trading and as such, is event trading. Events such as the election period can provide opportunities for traders to capitalize on. Now, they would need to do the one thing that I do say, of course, to traders and everybody who's is looking to do such thing is do your homework and be attentive. The two main things. I have heard some horror trading stories due to blunders and misfortunes that have not gone exactly the best way. So we want to make sure that obviously our traders who are listening, that we can make sure that we can sort of give them that sort of heads up. Be cautious so that you don't fall into the same category.
Yeah, which falls perfectly in theme, right? With what we're going to do. We're talking about whether to go ahead with a trade or whether it's a trick in disguise, right? So now that we're talking about horror stories, I do have a stack of them from trading communities. Let's have a look at them, and you can tell me what you think.
Absolutely, let's do that.
Okay, so we have one that talks about a crypto trader losing about 2 million betting on Joe Biden for the 2024 U.S. election. So that's fairly new. That's like a couple of weeks ago, right? Before,
a few months.
A few months
couple of months now.
Couple of months
it rings quite a bit bell. But it was quite recent actually.
Yeah, I'm just going to read this, okay? So only 3 weeks ago, Joe Biden seemed like a low-risk and relatively safe bet to be not only the Democratic nominee, but potentially also the 2024 US presidential elect. But all that changed after a disastrous debate left the Democratic Party scrambling and in complete disarray. So unfortunately for one gambler, trader, right, by the name of Anon Biden Bull. Wow, what a name.
Amazing.
That relatively safe bet, ended up costing them about $2 million, right? He lost 1.8 million betting that Joe would be the Democratic presidential nominee. Well, that's not happening. So whether whether you bet for him or not, you're gonna lose that 1.885 million, right? And you lost 38K betting that Joe would win the popular vote, and 104,000 betting that Joe will win the 2024 presidential election. He really went all in on this. So there's
happening.
The post ends, right? Maybe next time you lose $100 getting rug pulled on the newest altcoin, don't feel so bad. Wow, but 2 million just gone like that. I don't think there was a shadow of a doubt, back then at least, they were thinking that he would be the presidential nominee at least, right? But who knows? Right?
Definitely. Look, this is one of those things. It just shows how a single event or a single debate or a single speech can change absolutely everything. Because up to that point, regardless of his policies, regardless of what he has done during his election, his presidential period in itself in that 4 years, they were still saying, you know what, we could still go for Biden in comparison to Trump. But his continuous, let's say, disarray in the debates, misplacing names, misplacing names of presidents and people that he was meeting, caused his party. It actually was his party that decided he shouldn't be running, which put the pressure on him for him to withdraw. So there you go. There you have it. Do your homework always.
Sure, right. But would you call this bad luck? Was it just bad luck, or do you think that this was a trick? Would you classify this as a trade? Would you do it? Right? Would you take the risk? Is it a risk worth taking, or do you think that this was a rug pull?
You know what? I would have taken it, to be honest. I would have taken it. It would have been just one of those where I would have gone it, but I got the rug pulled under my feet. That would have been a trick for me.
Okay, right, but I guess there's a lot of context that's missing in the story, right? If I had 2 million lying about, and let's say I have $100 million in capital, let's say 2 million, it could be just like speculative capital that I'm just betting for fun. You get what I'm saying?
Oh, absolutely.
Right? Yeah, so
absolutely. Look, you gotta look at it prospectively. You gotta see it, because that 2 million is a horror story. Because if you put it in your perspective for yourself, it would hurt you. I think I'll be one of those zombies running around in the graveyards, just come back from the dead because I lost just 2 million. but if you have that portfolio, you have that availability, you have the ability. This is just one of those that you could have done the same level at a fraction of the amount that this person has done, and you would have had the same results.
Yeah, I mean, we have no idea how deep this guy's pockets go. I mean, he's anon,
Exactly.
right? Yeah, how deep his pockets. So for you, if you had $2 million lying about, and it took up like only a fraction of your portfolio, you do that bet. It seemed like a pretty safe bet.
Absolutely. Absolutely, because we didn't think that this going to happen. It seemed like a safe bet because nobody really was thinking that going towards that, and I would have probably done the same thing with the information at hand at the time. Let's forget.
Okay, yeah, I'm gonna hit the because of you, right? I'm gonna go for the trade button, right? Okay, I'm just gonna press the trade button right here. Okay. Okay. Right. So let's go to the second one. Right.
Let's go.
Okay, this one reads, any good advice while trading for election day? So I personally trade on USD pairs. I saw in November when Republicans won, the price went up. So any advice for a swing trader or a scalp would be much appreciated. So this guy replied, I closed all trades yesterday. Best to stay out during election in my opinion. I was short pound USD the day of the election in England. I closed my trade with profit, but had been thinking about holding on to it. So when the New York session closed and GBPUSD started rallying several hundred pips, I think it rallied like about 400, 500 pips. So he was shorting it. So when it started rallying, he would have been in a very precarious sort of situation. So I guess in a way he sort of avoided things, right?
Yep.
So yeah, what are your thoughts on this?
On this one, I probably would say that again, good call to close the trade to come out, because it could have been quite dramatic. Could have got tricked dramatically, rug out, hold the position, and you got to be careful. And this is why I mentioned earlier in our earlier little segment that volatility election short-lived to that extent because of what's happening there. And this is a very good example of it. He had it in one direction on the basis of what's going on, decided to close it, which sort of helped him in that sense, and then start to rally again, start going again. Now, in the thought of holding it and thinking that's going to continue, he could have been in a much more different position than
500 pips.
than he is than he is when he wrote that comment.
But I do have a question though. I mean, in this case, it's pretty much. I guess it's a no-brainer. You're making, you have some profit, so closing it, there's not so much mental resistance. But let's say you're down by a bit, right? You haven't realized that your losses. You haven't realized your losses. You're down by a bit, right? And something volatile is about to come, right? Election, some key event. What's your usual advice to traders there in that sort of situation?
So in a situation like this is one thing I always used to say, and this is something I used to discuss with fellow traders who normally come into this sort of situation or have dealt with similar situation, is when you get to this sort of sector, this sort of instance, the one thing that traders decide with is emotion. Because at that point, you're either losing, you're in a bad situation, you're trying to recover. So you're making a decision on emotion, and that can sometimes backfire. That can play the most, out of all the things that we can see, it can play the cruelest trick of all to you. So I always say, try to keep a cool head, try to look at the data, try to look at the information, and make a decision then. If you just base the decision based on your emotion alone, 9 out of 10, you get the rug pulled out from underneath your feet. Let's put it that way.
I see. So you're saying that they should take that small loss, if they're just down by a bit, they should take that loss and, account, try to make up for that loss somewhere else rather than.
Absolutely. It's something that you said, like small loss, because there's something actually interesting that you mentioned yourself is, there are various traders. There are different people, different conditions, different availabilities, different portfolios. So everybody has got their own. So obviously you base it on what you're doing yourself for your portfolio, on how you're trading. So the best thing usually in this situation is that sometimes the human factor, like yourself and myself, we don't like to see minuses. We don't like to see losses. But sometimes it's in the long run, it's worth taking that small negative, that small minus, that small little loss for the potential long-term run where you can make that money back in a different manner or in a different way or a different asset.
Interesting. So for Oog, who's the poster of this account of this comment, you'd say it's a trade. It was a good trade. He did the right thing. Okay, I'm gonna press the trade button again. Awesome. Right. No chance to press the trick button. It seems like everybody's making all the right decisions. Right.
Well, I have a feeling that might change though.
Okay. So now that we've talked about a couple of things, a couple of case studies, so to speak, right? Now that we've warmed our listeners up with some election ironically chills, right? It's I think we'll move to the next segment, right? We'll talk about some trader blunders and some near misses that you've observed, right? So there are moments in time, right, when you hit that buy button and you immediately wonder if it just cursed your account. So I think we should put them through the this trade or trick test. So I do want to hear about this stories from you, right? You have so much experience in the markets. Do you have any rookie mistake stories that still make you shiver?
I just recalled actually one quite tricky one actually, and this was something that happened during the I think that was during 2020, so around the election. Again, see, election comes into play quite often, but there's something here actually. So I'd obviously remember in 2020 we had the election, but also we had another event that happened. Of course, something that that scared everybody, which was COVID. So markets obviously reacted. Markets, went on a different level. Now, while the markets recovered from the March 2020 sell-off, where everybody was selling, energy sector was down, stocks, shares, everything, right? Now, there was a fear of what we call a dead cat bounce, which means basically a further decline. So, so during that sell-off, we had the rookie one waiting patiently on the sideline, thinking that, it's going to be a further sell-off, so they can buy it at a much, much lower price. And then they watched on the sideline while the stock market started to climb higher and higher and higher.
Wow.
After realizing that the bull had indeed defeated the bear, stocks were bought actually at eventually a much, much higher valuation. So, the opportunity to have, made enormous amounts of potential profits and gains during this period, were lost. But there were lessons learned. There were lessons learned in this though. One, timing the market is extremely difficult. When you always say, let me wait for that extra point, let me wait for it to round up to that extra dollar, it's not always the case. Sometimes in the wait for that extra dollar, extra pound, extra euro, you could always end up risking losing more. And that was one of those. And the other one is, dollar cost averaging can serve you well because it can reduce the impact of regret aversion. The tendency of retaining from making decisions to prevent any potential mistakes, i.e., I should have bought or I shouldn't have bought. It can be quite helpful for that. And actually, you know what? With that saying, I came across a quote a little while ago, which I think would be quite fitting for this. The quote I remember it says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves.
Interesting. I do. Is it just painfully apt because we're talking about spooky stories, right?
Yeah.
It's called a dead cat bounce. Like really, a dead cat bounce. Like if a cat falls off a building, it bounces, and that's the trajectory we're looking at.
Yeah, dead cat bounce because the dead cat will fall.
Who names these things? Who names these things? Seriously.
Believe me, I would love to have a meeting with them because I think they would have stories to tell until the next century.
Very creative folk. Very creative folk.
Definitely. So it's quite fitting actually when it comes to that. So the dead cat drops, you have the belief it's going to bounce, but no, it's not actually. So that's the fear of the decline.
I see.
So quite
So
fitting for that.
back to the borrower story. So it's
Yeah.
it's always about people trying to time the market, right?
Yes.
The horror story is about people who are trying to time the market and always looking for the right timing to go in, but inadvertently miss that opportunity because
Of
they
course.
we can only look at things from hindsight, I suppose, right? And
Yep.
always the anticipation rather than having a valid principle to guide them,
Of course.
to when to enter into the markets can
Yeah.
I guess be detrimental to their portfolio, I suppose. Yeah.
Most definitely.
Okay, I do
Most
have
definitely.
some other trading stories that are more general. A couple of rookie mistakes they call them,
Okay.
right? So
Wow.
I'm just gonna read. I'm just gonna read them.
Yeah.
Okay, this one is by
Yeah. Let's
appropriate
dive in.
box. Appropriate box.
Hmm.
My friend took a 12K loan, thinking he could just trade using signal providers and make loads. Signal providers, I suppose he means like copy trading, right? So he
Yeah.
had no risk
No way.
management whatsoever, and that 12K was gone in a few days. Traded gold during some news back in 2019. This was gold copy trading, and they said that it says here, absolute idiot, had to get a debt relief order in the end, right? Should he have continued trading? 12K in, or did he get tricked?
Look, in this situation, I think he got a combination, but he definitely got tricked because the one thing that you have to take into account, you can't just have a 12K loan, go into it, and then think that you're going to become a millionaire, especially if you're ignoring risk management. And funny enough, I think one of the comments was that how can someone ignore risk management? It's yeah, in a situation like this, is trick because if you're relying purely and solely on someone's signal or someone else's information without doing your own due diligence, definitely get tricked.
Yeah, I mean, even if the other person was in the green, it could be something that's more prolonged, right? He might have the capital to lose a bit, and he can make more money on his other
Yeah.
other trades. So yeah, I think this is a trick. Okay, I'm gonna for
Yeah.
the first time, I'm going to finally hit the trick button.
Let's
Awesome.
go.
Right. And okay, next one. I lost 10K of my savings in trading Forex. This guy is called Malaysian PF. Right. What should I do? Okay, I'm just going to read his story. So, in the last few months, I was really fed up with my 9 to 5 job. I saved up 10,000 ringgit because I wanted a change and I thought Forex trading could be my ticket out. I resigned and jumped head first into the Forex market. Wow, this guy is really committed, right?
Amazing. Wow.
First thing, no experience whatsoever. Just
dive straight
all
into
in.
the deep end.
Yeah, I was trading all kinds of pairs like the Euro USD, the exotic pair GBP JPY, and the USD
Right.
CHF, thinking I could make a quick buck. One day I decided to go big on the trade. I put a huge amount into a GBP JPY position. Wow, this exotic pair, hoping it would go up because I was feeling confident after a few successful trades. I thought it was a sure thing, but then out of nowhere, the market took a nosedive. So within just 1 hour, the GBP JPY pair moved drastically against my position. It was like a bad dream. My trade went from being in profit to a massive loss. I watched in horror as my 10,000 dwindled to nothing. Probably got margin called. I tried to hold on, hoping it would turn around, but the losses just kept piling up. By the end of the hour, I had lost all my savings. It was a hard lesson for those that it was a hard lesson. There was a laugh after it, but that's a more, I guess, a more local lingual thing. I learned the forex market is unpredictable and not as easy as it looks. Also, he paid 10,000 for a class. That's not so bad, right? Now I'm back to square one, figuring out my next steps. It's a tough experience, but I guess part of the journey. Got to learn from these mistakes and plan better for the future. So the short version of the story, he quit his day job to pursue forex trading after saving 10,000 in his own money, and he finds himself back at square one. Do you think he should continue trading, or did he get tricked?
In this instance, I would say he got tricked because he got tricked actually by himself. He was actually in profit and saw those profit disappear and went into the losses. And this is where bit of greed comes into play because we always want that little bit extra. We always want that little bit more. We always want a little bit more profit. If you're taking profit, because at the end, one thing I always say if your positions are in a profit and your trade is going quite well and there's a positive, it's still more than what you started off with the trade.
That's true.
So actually, that means that you did quite So,
Yeah.
but by the time, obviously, we know, obviously, if the position doesn't close, you haven't actually lost it. For all we know, the position could have always changed in his favor. But, as an inexperienced trader, like he said he was, I think in this instance, you got tricked again.
I see.
Especially if you're quitting your 9 to 5 as well and putting everything in there without any experience.
You have no, you have no track record. It's like just me deciding to quit my job and become a pastry chef. Like I had no idea how to make pastry whatsoever. Just
go straight to a straight high-end bakery, Michelin star restaurant.
Yeah, it's like I don't know, man. It feels like a bit of a leap, but I don't know.
Yeah.
Maybe he just felt like he was confident enough. Maybe he attended a lot of classes. But while you say it's a trick, I got to disagree just a little bit because I think he did learn something. He learned something, right? He learned that not to put.
Definitely. Oh, absolutely.
Yeah, it's a painful lesson. Every time he looks back behind his shoulder, he's gonna think, "Yeah, I lost $10,000 trading, putting all my eggs in one basket." So that's important. That's an important lesson that you learn. And yeah, but yeah, you know what? Yeah, I do agree with you. I mean, at least I think a good 90%. He was ultimately the own obstacle to his progress. So yes, trick. All right. I'm just gonna read one last one. Okay, this one. I don't know. This seems a little contentious, but I'll let you decide.
Ooh.
His name is Bit Visual. Right? He says, using a stop loss makes you unprofitable. Prove me wrong. So he says he's interested in listening to what you guys feel about not being having a stop loss, and if they know any profitable traders who don't utilize it. But if you feel like a stop loss is vital, then share their performance, and they want them to show a real account. So he's saying that he is profitable with no stop loss, and if he does use one, okay, so it seems like he does use one, it's 100 to 200 pips. So do you think he's genuinely profiting from his trades, or he's just someone that's just an accident waiting to happen, like a trick?
No, I think this one is actually quite how shall I put it? Using stop loss can be quite useful to that extent, because obviously, especially with new traders, the only thing is how you use it. That is my thing, because at the end of the day, the one thing that it comes down to is always human factor. Because at the end of the day, like I mentioned earlier, it's something we don't want to see. We don't want to see minuses. We don't want to see negatives. So what happens is usually when it becomes unprofitable is that when a trader plays a position, they are not taking, let's say, the necessary right risk management assessment on how much they should risk losing in comparison to what they should making. So what happens is that the trader then ends up putting the stop loss way too close to what the market value is right now, because they're like, oh, I don't want to lose too much. And what happens? Position stops out, position closes, they see the negative. What happens? All of a sudden the market starts to go in the direction that they actually want to go into. So, and that's why you would say it's unprofitable. But the one concept of it is understanding this: market is a roller coaster. Nothing ever goes in a straight line up, and nothing ever goes in a straight line down.
Yep.
So we have our ups and downs, we have our little loops, we have our little dips and dives. So accounting for those dips and dives and making the necessary risk management, and say, you know what, I am willing to risk X amount, and using that stop loss can become quite potentially profitable for you in that sense. So
I see. So they should start factoring in like how much they're willing to lose. If the point of the stop loss is not to make sure that you have zero losses, but rather to set the extent of your loss. How much you're willing to lose, right? If it does happen. Okay,
managing it definitely.
That's actually really good advice, like especially for people who are new to the markets. Yeah, you really have no benchmark to set, where you want to.
They don't. Usually one of the questions that normally is presented, but how do I know at sort of what level should I put it? Something that we know as analysts, or something that we always present to traders is this. There are many ways that you can present, but one of the things that you always sort of present is a ratio factor. For example, 1-to-3 ratio, 1-to-4 ratio. So for every let's say 10 that you're willing to make, you have to be willing to maybe risk 30, because we know that, let's say if it's a 1-to-3 ratio, because you can see that there is the possibility that it could go down to the negative of almost 20-25 before it actually goes up in towards the potential profit that you're looking for. So something that you can take into account, of course, but obviously there's various things, but definitely something to look out for.
Awesome. Right. Thank you so much, Ash. I think, you've really shared a lot of illumination, like the lantern, like I said, you were going to
My
be
pleasure.
to the new traders out there who are, I guess, still in their, beginning steps of the market. So
Thank you
I'll
very
look
much.
forward to talking to you guys again. And I look forward to bringing you the latest analysts to share with us their opinions and their perspectives on how the markets should be traded. Join us for the next episode of the VT Markets Traders Brew podcast, where we'll continue to explore the fascinating world of the financial markets. Whether you're a seasoned trader or just starting out, there's always something new to learn. Our podcast is available on Spotify, Apple Podcasts, Amazon Music, and iHeart. Be sure to subscribe to us on those platforms for new episodes of our Traders Brew podcast. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. Trading leveraged products such as Forex and CFDs carries a high level of risk and may not be suitable for all investors. There is a possibility of losing all your initial capital. Before trading, you should fully understand the true extent of your exposure to the risk of loss and your level of experience. Please note that past performance does not constitute a reliable indicator of future results. Future forecasts do not constitute a reliable indicator of future performance. If you do not fully understand the risks involved before deciding to trade, you should fully consider your investment objectives, level of experience, and risk tolerance. You should become aware of all the related risks and seek independent advice from a suitably licensed financial advisor.